I know lots of people who are educated far beyond their intelligence. Louis Grizzard. Welcome to Retirement Mentorship, your mentor to and through retirement. I'm your host, Freeman Lindy, Certified Financial Planner. Today we continue with part 3 of life insurance lies, uncovering the myths and strategies used to sell life insurance and why it is not always the best for most people. That's coming up on the Retirement Mentorship podcast. First, the 2-Min Tune-In, where we cover the primary points of the podcast in the first 2 minutes. The life insurance lies we'll be covering today are 3. Number 1, independent experts confirm that permanent life insurance is better. You'll hear a variety of versions of this argument claiming independent experts that affirm that permanent life insurance is a great strategy or is better than other strategies. However, these experts or studies are often comparing permanent life insurance to other inferior strategies. Again, we don't want to compare permanent life insurance to the worst strategies. We want to compare it to the best and see how it stacks up. It does not. Number 2, successful wealthy people own life insurance. So should you. Here's another fallacy of claiming that because someone owns it, you should too, even though their life circumstances and financial situation are not like yours at all. Just because Bill Gates does something doesn't mean that you can or should. And number 3, infinite banking is a great strategy. If you haven't heard of infinite banking, well, that's good, but you may. So keep tuned to this one and we'll break down why this very popular current strategy is not a great strategy at all. That's coming up on the Retirement Mentorship podcast. One of my goals in this series of podcasts is to give you a moderate depth of knowledge on how to combat some of the strategies you may be up against from people trying to sell you permanent life insurance. It'll get a little technical at times, but also not as deep as you may need to be if you're facing certain sales strategies. My goal is to make sure you have something more than, well, Dave Ramsey says that cash value life insurance is bad, therefore I'm not going to get it. Trust me, there are plenty of sales strategies and tactics that can get around appealing to an expert on why it's bad. You need to have a deeper level of knowledge than that. We also, though, won't give you enough technical knowledge to really combat a specific strategy used against you. If you find yourself in a situation where an advisor has or is trying to sell you life insurance and is coming up with all kinds of great reasons why you should have it or get it, and you can't quite figure out exactly where the fine print is and where it breaks down, send those specific situations to us and we can give you the exact reasons and language for why it is not great in your situation. With that being said, let's continue on with some of our life insurance lies, some of the strategies and sales tactics used to sell life insurance, and break down why they are not that great after all. Myth number 1 of today's podcast. Independent experts confirm that permanent life insurance is better. Again, you'll hear lots of varieties of this argument. You might say, well, I've heard that buying term and investing the difference is better than buying permanent life insurance, so let's do that. And your advisor or insurance sales agent might proceed to bring out a study or an expert or somebody who says that permanent life insurance is actually better. Often they'll bring out these very large studies with graphs and charts and all these different reasons why permanent life insurance is better than whatever other strategy you could be using. They may first bring out their own company's sales materials on why it's a great strategy, which of course should be discounted immediately, but they may also bring out other studies and experts that are purportedly independent. It should be obvious to anyone that sales material built by a life insurance company to support life insurance as a strategy should be taken with a grain of salt. It's not exactly an unbiased source. So often they will try to bring out an unbiased source, someone who isn't benefiting from the huge commissions on permanent life insurance, who confirm that it is indeed a great choice. A recent one that I heard a sales agent talking about was a study by Ernst & Young, which is one of the big 4 accounting firms in the world. Accountants are typically against permanent life insurance, and so he was referencing this study as an example of how even the accounting firms who have been against it for so long have finally come around to showing that actually using permanent life insurance and annuities is better than not using them. I hadn't seen the study yet, and I didn't believe him, and so I looked it up later. And this becomes a classic example of how we use independent studies that study bad options against other bad options, instead of bad options against great options. So for example, in this Ernst & Young study, which he was referencing, they did indeed come up with an exhaustive study comparing various strategies to permanent life insurance and fixed annuities. They looked at a classic buy, term, and invest the difference approach only, plus that, and permanent life insurance, plus annuities, plus both, and compared all four situations. And what they confirmed at the end was that you had more flexibility and better outcomes if you purchased permanent life insurance than if you just bought term and invested the difference. That was the conclusion of the study, indeed, from one of the big four accounting firms. So, if that's what they're saying, and they're independent, and they're not benefiting from either investments or permanent life insurance, shouldn't that be believed? Isn't that the conclusion we should reach as well? That permanent life insurance is indeed better strategy than any strategies without it? Short answer, no. The study is misleading, and anyone who simply references it without looking deeper at it is also misleading. What they did in the study is confirmed a strategy using permanent life insurance and fixed annuities with the Morningstar Moderate Glide Path. Now, if you're not familiar with this glide path is what many of the target date funds that you find in 401ks and other employer-sponsored plans are based off of. The strategy basically has a percentage of equities and a percentage of fixed income, with the equity percentage being higher at the beginning of your career and lowering as you approach retirement and beyond. So, for example, if you are 30 years old and you're planning to retire at 65, the moderate glide path will put you at 90% equities and 10% fixed income. That means for 35 years, at least 10% of your overall portfolio will be invested in fixed income, earning approximately 3 to 4%. As you get closer to retirement, the fixed income portion begins to increase, starting at about 25 years out from retirement. So in our example of a 30-year-old retiring at 65, your fixed income percentage would begin to increase at age 40. And by 15 years out, or age 50, 20% of your retirement would be in fixed income, making 3 to 4%. 10 years out, you were at 30% of your money in fixed income. 5 years out, you were at 40% of your money in fixed income. And by the time you retire, you are at 50% fixed and 50% equities in your total investment portfolio. But it doesn't stop there. It actually continues all the way down, so that about 10 to 15 years after you retire, 65% of your money is in fixed income, making 3 to 4%, and only 35% of it remains in equities. That's the moderate glide path. Here enters in the comparison. If, over the very long term, a good permanent life insurance policy will average 4 to 5% in cash value, that is going to compare better than having 10% of your investment portfolio in fixed income, making only 3 to 4% over your entire life. Yes, it takes 30 plus years for the cash value to enter this 3 to 5% long-term return. But you've also had 10% of your total portfolio only making 3 to 4% over that time. So eventually, the long-term growth of your permanent life insurance cash value will beat out the long-term growth of your fixed income. And if you're getting all the way down to 50% fixed income or more, all making only 3 to 4%, yeah, you're probably better off having a larger chunk of your money making 4 to 5 in cash value than having that much in traditional fixed income. Thus, in this comparison, in this study, it's better to have permanent life insurance than investments only. You will have a better return long term. So what's the problem? The problem is that a moderate glide path is a dumb strategy. It was built by people trying to cover their own butts as they recommend investments to consumers, and is not at all based on wise or best practice long-term investment strategy. Why would you possibly want 10% of your portfolio always only making 3 to 4%? If you don't need your retirement money for 3 or 4 decades, why does any of it need to be making 3 or 4%? Again, this is not an investment recommendation. Speak with someone who knows about your situation and never take investment advice from a freaking podcast. But my point remains, if you're looking for the best financial strategy, the best financial plan, tying up a whole bunch of your money in fixed income over decades is not going to be as great as the long-term broad-based equity returns you could get over those same decades. Again, equities are bad over the short term. You don't know what they're going to do. They're unstable. But over the long term averages have always been high. There's no reason to keep low growth investments over the long term. You need them in retirement. You don't need them 40 years out from retirement. So yes, permanent life insurance looks good against other crappy strategies. But if you compare it to a good financial plan, it completely falls apart and pales in comparison. If, for example, you have 100% equities all the way up until about 10 years out from retirement, give or take based on what the actual market cycles are doing at the time, you will have so much more money by retirement that it does not matter that the long-term cash value returns will beat out long-term fixed income returns. You won't have either for long term. You then gradually move over to the amount of fixed income that you need in the last decade before retirement. Again, this is not a recommendation, but if you were doing actual financial planning with me in my financial planning practice, we would educate you and show you that you can actually get away with 20 to 30% in fixed income, not 50 to 65% in fixed income. And if you have that much more in equities, earning average equity returns, and sufficient amounts in fixed income to buffer you when equities go down, that will certainly beat out any kind of permanent life insurance strategy by a mile. I've done the math. I could show you the math. I could talk at length about the math, but we'll keep it short for this podcast. The same is almost certainly true of any other independent study comparing cash value life insurance to other investment strategies. If they come out saying that permanent life insurance is better, examine what strategy they were comparing it against. You'll probably find that that strategy is also subpar. In my financial planning practice, I have 0 clients following a moderate glide path. That also is a dumb strategy. Do your homework, get a true financial plan, a true investment plan, and you can beat out both poor investment strategies and poor cash value strategies. So no, just because some independent expert or study claims that permanent life insurance is better doesn't mean that it is. Better than what is a question that you should be asking. And if it's better than the best, no, it's not. Life insurance myth number 2, successful wealthy people own life insurance, so you should too. You hear this one thrown out every once in a while that so-and-so billionaire or millionaire owns a large portfolio of life insurance, or that banks own life insurance, or that some other successful wealthy person or entity owns it. And if the rich people are doing it, do what the rich people do, and that's how you get rich. Let me point out one thing right away. If wealthy people own life insurance, they're not wealthy because they own life insurance. They own it because they can't do anything else. If you are making hundreds and hundreds of thousands of dollars a year, you have already exhausted all the normal investment solutions that you can get. If you are on track or will pass on more than $22 million to your heirs, life insurance might be a good strategy. But comparing your situation to these very wealthy people who have already exhausted all their options is not something that you should do when deciding what you should do for yourself. You should be comparing yourself to other people in your situation, other successful people that are closer to your economic status. What are wise people doing with what you have? not what are wealthy people doing with their wealth. It's not a fair comparison. This is a common tactic that is used comparing successful wealthy people to what you should do, and it is very seldom true. Same can be said about lots of various investment strategies. Elon Musk owns a lot of Bitcoin, therefore I should invest in Bitcoin before doing a Roth or an HSA or maxing your 401k or any of the other things you should be doing. No, that is a fallacy. Do not compare your own situation with what billionaires are doing. Compare it with what wise, prudent financial planning suggests you should be doing with your current situation and finances. This one's pretty simple. Just ignore that life insurance lie. And life insurance lie number 3. Infinite banking is a great strategy. If you've never heard of infinite banking, that's okay, but we'll give a quick synopsis of it here. First, infinite banking is not a technical term. It is a marketing slogan slapped on a product and strategy around that product. Typically, it involves using an indexed universal life policy. These policies are frequently built so that your cash value is indexed against the S&P 500. There will be a floor and a cap. What a floor means is that if the index does less than the floor, you won't go lower. So if it's indexed against the S&P 500 and the S&P 500 has a negative year, you get 0. You don't actually see any negatives. There's a floor. So it can go up and it can go kind of down, but only down to 0, and it will never be less than 0. So no matter how many bad years the S&P 500 has over the decades you will be in it, you will never do worse than 0 as far as the investment portion is concerned. Then there'll also be a cap, which is maybe 12%. And so the philosophy goes, look, you're going to get a 0 floor. You can never lose money in this product. And it'll cap you at 12, which means that if the market does better than 12, then you won't get any more than 12. So if it does 15 in a year, you'll only get 12. If it does 20 in a year, you only get 12. But anything in between there, you will get. So if the market does 7, you get 7. If it does 2, you get 2. If it does 12, you get 12. If it does 15, you get 12. If it does negative 30, you get 0. And so that's typically how those work. And then the infinite banking part of that is that you put as much money into as you can, have a small death benefit so that the internal expenses are low, and put a whole bunch of money into the cash value portion of it as much as you're allowed to by law, and you can really build this thing up to be a huge amount. And then all the other benefits of permanent life insurance apply. You can loan money out tax-free, and so it's a great way to pull money out at any time for any reason and pay no taxes on it. And you will also get these great returns because, even if you're getting capped at 12%, the market average is, 8% or maybe 10% at the most. And so even if you're getting capped at 12, it doesn't matter. You're going to get most of those returns with no downside. So what's the problem? It seems like a great strategy. 0 downside. Your cap is higher than the average anyways, so you'll get most of those returns. You can take money out at any time for any reason and pay no taxes on it. Seems like a great strategy. And the infinite banking then is that you become, quote unquote, your own bank. You build up this great amount of money that you can never lose on, removes the market risk, and you can pull that money out and kind of loan it to yourself at any point for any reason and never have to borrow from a bank again. Better to pay yourself that interest than to pay it to a bank. So what's the problem? Seems like a great strategy. Seems like a great product, first of all. Where are the downsides? So first, let's look at the downsides of the indexed universal life products. First, their floor of 0% is just on the index part of it. You can still lose money in a year because these policies, these products have internal expenses to pay for the actual insurance, and those always apply. What's more, they're variable, so they might be set at a certain amount to begin with, but the company can raise those to almost whatever they want. There are limits, but they are allowed to raise those, and it's built right in the contract what they're able to raise those to with no prior notice. And so they'll illustrate them at the lowest possible expenses, but the expenses might be a lot higher depending on the status of the company at the time. If they need to jack up those costs, they can. And if your costs go up, your returns go down and will go negative in a year when the S&P 500 is down. If you're getting 0% on your investment return because the market was down, but you were also paying 2% in expenses, you still lost 2% on your cash value that year. So first, the floor is a little bit misleading. Second, the cap is very misleading. It's often portrayed as, well, there's a 12% cap, and so if if the market is doing 8%, then you're going to get most of that, and you're only going to be occasionally capped. But here's the problem with that. The market almost never does what it averages. It's usually way higher or way less. I think I mentioned this in a previous podcast where over an 80-year period, the S&P 500 had averaged 9%. Okay, perfect. That's under the 12% cap. So you should get most of that, right? Well, no. Over those 80 years, the number of times that the S&P 500 returned between 7% and 11%, plus or minus 2, was only 4. The rest of the times it was way higher or way lower. So look at where the caps and the floors are on that average return. If you're averaging 9% and your floor is 9% lower than that, meaning you can do 9% less than average before it caps you on the floor side, but it's a 12% cap, it means you're only 3% above average on the cap side. You can't look at it as, oh, look, we've got this great upward cap and that allows plenty of growth and a 0% floor. What you have to look at is how many percents it is off the average. So you're going to get capped at 12% way more often than you will hit the floor at 0%, especially since on average the market is up 4 out of 5 years. It's up way more often than it's down, and it might average 9%, but you're going to get capped way more often. And so you won't actually get average returns. If you're getting capped at 12% every time the market's doing 30% or 16% or 24% and all these great returns that we've seen over the last 100 years, but you're only hitting the floor occasionally, maybe 1 out of 5 years, your returns will not be the average of the S&P 500. Your returns will be closer to 5 or 6% because that is between the caps there, the floor and the cap, rather than the actual index return of 9 or 10 or whatever the S&P 500 indexes over that time. And so right off the bat, this notion that you can get S&P 500-like returns with no downside, with 0% losses, is false. You will not get that. Mathematically, it's impossible. Mathematically, you will always get much lower than the equity returns of the general market than inside these products. And so that right alone is reason not to do it. If you could invest in the S&P 500 directly through an index fund and actually average that 9%, you will automatically do better than the 5 or 6% that you will average in these products. And that's just on the index. You add in all the fees of the actual life insurance product itself, and perhaps your returns will be closer to that 4 or 5% mark than 5 or 6. And so you will have a 5% rate of return or a 9% rate of return over 30, 40, 50 years. What's going to do better? Come on, people. We know the answer to this. Investing in equities directly will always be superior than investing in some product that indexes against it. It mathematically always is the case. The company needs to be getting profit out of this. It needs to be getting something. It's getting its fees no matter what the S&P 500 does. And because of the caps, you will never get equity returns in these products. And so first, don't be fooled by this lie that you can get equity returns without the downside. That's just straight up false. That does not exist. As Carl Richards says, certainty is easy to sell and impossible to deliver on. And so they feed on this fear of market, the fear of volatility, the fear of the market going down. And when they present to you, hey, you can get equity returns with no risk, it appeals to us at a deep level. But it's just not true. You can't. You've given up one or the other. Either you give up the volatility and you also give up the returns, or you accept both. The second part of the infinite banking strategy then is that you can always just be borrowing against this product and you get all these tax-free returns, which we covered last time. Again, if you've gotten 5% cash value return in this product over 30 years versus 9% in the general market, it doesn't matter if you're paying 15% capital gains. Your after-tax return on 9% will be much better than your tax-deferred return of 5%. Mathematically, it just happens. So first, it's not even a great return vehicle. It's not a great tax vehicle. And third, there is the element of an increasing cost of insurance. The cost of insurance is very low when you're young and when you often start these policies, but by the time you get up into your 60s and 70s and 80s, the cost of insurance is very high. And so if you plan to pull money out of this infinite bank, so to speak, to be able to do things with it, it may work to pull it out for a short period of time, for a year or two, and then put it right back. What you cannot do is pull it out and leave it out, because the costs will always keep increasing. And you need enough money in these policies to generate enough interest to be able to pay those expenses. And if you pull the money out of the policy as a loan, then there isn't enough money in there to generate enough interest to pay these expenses. And the expenses will continue to rise and eat away at your returns later on in life. So yes, it illustrates very well in the early years, but later on, what happens when you're trying to take money out of these things and the expenses keep coming, and then your zero return is definitely not zero anymore. It's now multiple percents that's being pulled out of this account, even when the market is up. And the worst part of these things is that if your money goes to zero, if the cash value goes to zero, the policy lapses and goes away. So let's say that you've put a bunch of money into this thing, you've put over your lifetime $100,000 into one of these products, and you've pulled a bunch of money out, and let's say it does grow really well, and you got all these great 5 or 6% returns on it, which seems awesome. And so in retirement, you've pulled $200,000 out of this thing, tax-free, tax-deferred. It's all been awesome, right? It kind of performs the way that it's illustrated. So you put $100,000 into it, you pulled $200,000 out of it, tax-free. You've gotten an awesome double your return with no taxes, but then the expenses eat away and destroy the policy and it lapses. What happens then? Well, the first $100,000 that you've pulled out is tax-free because that's your basis, and that's what you put into it. And so $100,000 of it will be tax-free, but the remaining $100,000 that you pulled out, quote-unquote, tax-free earlier, if the policy lapses, that all becomes taxable in the year the policy lapses. And so now you have $100,000 taxable at ordinary income all at once. That is going to spike you into a new tax bracket. I will tell you that right now. So because you believed this baloney about not wanting to pay any taxes and about people making you afraid of taxes, and you didn't want to pay 15%, which you could spread out over several years, instead you now owe taxes on all of those gains all at once at ordinary income rates of 20 to 30%. That's not good math. You're creating a tax bomb for yourself later. And if you've already spent the money and now the policy lapses, all that money that you've already spent that you don't have is now taxable now. Where are you pulling the money to pay those taxes? From your 401k, creating an even bigger tax problem? Probably going to have to. And so while these policies illustrate well and while the strategy seems to make sense in a 15-minute sales pitch, when you really break it down and when you really look at what happens in life and the flexibility that life throws at you, they're not good strategies. There are better strategies out there. Again, not the worst. I said that I think last episode, that the different cash value strategies are not the worst possible strategies ever. There are worse things you could do with your money, like put it under your mattress. But we should be comparing them against the best, and these are certainly not the best. I've never recommended the infinite banking strategy. I never will, and I recommend that anyone who's considering it first explore a true financial plan. And if you still like the infinite banking strategy better, then after you've created a real investment plan, you can do it. But I don't think that will be the case. So there you go, your 3 myths for today. Independent experts confirm that permanent life insurance is better. Yeah, better than other crappy strategies, sure, but not better than the best. Successful, wealthy people own life insurance, therefore you should too. No, their situations are much different, and they're facing way different tax problems and investment problems than you are. And so just because someone who's a billionaire is doing it doesn't mean you should be doing it. And third, infinite banking is a great strategy, maybe better than other terrible strategies, but not nearly as good as a broad-based equity plan that is carried out throughout your whole life. So get a real financial plan, get a real investment plan, and you'll be better off than these investment banking strategies. We've got one more episode, part 4, on life insurance lies. Then we'll look briefly on a very narrow subset of situations where it can make sense, and we'll also wrap up with learning how much term insurance we actually need. We said that at the beginning, that if you have dependents, you do in fact need life insurance, and you should get that in term. And so we'll cover how to calculate exactly how much you need, and then we can be done talking about life insurance and moving on to other and more fun topics. So stay tuned, and we'll see you next week. This podcast is educational only and is not intended to be investment, legal, or tax advice or recommendations, whether direct or incidental. Again, this is not investment advice. Consult your financial, tax, and legal professionals for specific advice related to your specific situation. Never take investment advice from someone who doesn't know you and your specific situation. All opinions expressed in this podcast are the opinions of the speakers expressing them. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Retirement Mentorship is not affiliated with or controlled by any registered investment advisor, broker-dealer, or other financial services company.